30 days of war explained what actually happened. This is no longer a war, it's a financial event. 30 days, that's all it took for a global markets, oil prices, and investor sentiment to completely shift. But if you've only been following headlines, you've missed the actual story because this wasn't just a war. It was a sequence of reaction, expectations, and market adjustment. So, in this video, we are going to decode the last 30 days step by step so you can actually understand what happened and how to think about it. This isn't just about geopolitics. Every major global event like war, crisis, collapse follows a pattern. If you understand pattern, you don't just consume news, you interpret it, and that changes how you make decisions. February 28th, the US and Israel launched Operation Epic Fury, striking Iranian command centers, IRGC headquarters, and ballistic missile sites. Supreme Leader Khamenei is killed within hours. Within minutes, crypto markets flash crashed. Brent crude surged 10 to 13%, hitting around 80 to 82 dollar a barrel by March 2nd, its largest opening shock since the 2022 Ukraine invasion. The Dow Jones fell over 400 points and the S&P 500 dropped 0.7% on March 2nd. European and Asian indexes fell 1 to 2%. Japanese Nikkei dropped over 2%. The S&P 500 had reached an all-time high on January 27, 2026. Buoyed by cooling, inflation, and AI-driven earnings growth, that optimism was now being unwound fast. But here's the key. Markets weren't reaching to what happened, they were pricing what could happen next. Once the initial stock settles, something else takes over. Narratives. Media coverage increases, countries take positions. Speculation begins, and this is where markets shift from reacting to facts to reacting to expectations. Iran's closure of Strait of Hormuz disrupted 20% of global oil supplies and significant LNG volumes. Ship transits through the strait dropped 95% in the first week of March. According to S&P Global Market Intelligence, from March 1st to March 8th, just 55 transits were recorded, compared to 160 the week before. Normal is around 115 vessels per day. Qatar declared force measures on its gas exports after Iranian drone attacks. Qatar supplies 20% of global LNG. Saudi Aramco's Ras Tanura refinery and crude export terminal also closed due to attacks. Iran also launched what is described as its most intense operation since the beginning of the war, firing advanced ballistic missiles towards Tel Aviv and Haifa. 4,000 flights cancelled daily. Emirates, Etihad, and Qatar Airways all grounded. Prices aren't moving on events anymore, they're moving on expectations. This is where most investors start getting confused. What makes this event harder is that expectations are not fixed, they change every hour. One headline suggests escalation, the next suggests de-escalation, and markets don't wait for confirmation. They constantly reprice probabilities in real time. So what you're seeing is not instability, it's continuous adjustment, and if you're only reacting to the latest update, you're always one step behind the market. And then something counterintuitive, markets stabilize even as the conflict continues. The IEA announced member countries had unanimously agreed to release 400 million barrels of oil from the strategic reserve. The US alone would contribute 172 million barrels from its strategic petroleum reserve starting immediately, and yet oil prices stayed above $100 a barrel. Brent crude futures rose 36% from February 27th, the last day before the war, though March 27th, when prices traded about $113 a barrel, but the Dubai physical price, which tracks actual Middle East delivery, was up 76%, more than twice the paper price, reaching $126. Goldman Sachs estimates a $14 to $18 per barrel geopolitical risk premium baked into prices. Why? Because once the worst case is priced in and nothing worse happens, markets recalibrate. This is where experienced investors behave completely different from retail. This is where things get messy. Brent crude plunged 17% to fall below $80 on a single session, then rebounded to near $90 after the US Secretary of Energy posted, then quickly deleted a claim that the US Navy had escorted an oil tanker through the Strait of Hormuz. The White House later confirmed no such escort has taken place. Bitcoin hit a day high of $71,493 and a day low of $68,679 within a single session. Gold fell nearly 70% through the month, on track for its worst month since October 2008. As higher oil prices shifted inflation expectations and raised the opportunity cost of holding non-yielding assets. The 10-year Treasury yield climbed roughly half a point over the course of the war to 4.4%, reflecting worries about inflation and the prospect that the Fed may not cut rates as hoped. And this creates volatility because now markets are not reacting to events, they're reacting to interpretation of impulse. Eventually, markets start choosing a direction again, not because everything is clear, but because one narrative becomes more dominant. WTI crude settled a $102.88, its first close above $100 since July 2022, and is on pace for its best month since May 2020, up about 53% in March. Monday also marked Brent surging as high as $119 a barrel. Goldman Sachs warned that if the Strait of Hormuz remains closed into summer, the S&P 500 could see an additional 5 to 7% decline as the impact on global GDP becomes more pronounced. Gasoline prices at the pump edged towards $4 a gallon, up more than $1 since the war started. Trump warned Iran that the US would destroy its oil wells, power plants, and Kharg Island, though which roughly 90% of Iran's oil flows, unless the Strait of Hormuz was reopened. Yemen's Houthis entered the conflict firing ballistic missiles at Israel targets, marking a future escalation and rising fear of disruption. To the Bab el-Mandeb Strait, through which 4 to 5 million barrels per day transit. Markets have chosen a direction not because everything's clear, but because one scenario has become most probable. If we zoom out, three major things happened. Uncertainty was priced in immediately. Markets adapted faster than people. Narratives drove prices more than events. This wasn't random, it's a pattern. Most investors react to what already happened. Markets react to what might happen next. That gap is where mistakes happen. People enter late, exit early, and keep changing decision based on headline. The S&P 500 is down around 7% year to date, the 14th worst start to a year in history. Less than 20% of S&P 500 stocks are trading above their 50-day moving average. The VIX Fear Gauge topped 31, well above its historic average of 20, and yet one analyst put it simply: if there is an ultimate ceasefire or substantial de-escalation, stock will rally substantially. Given that current oversold status, this is not about predicting the next move, it's about understanding structure. When you see stock, narrative, adjustment, confusion, direction, you stop reacting and start interpreting. Because the next time something like this happens, and it will, you'll face the same choice, react or understand, and that difference is what separates outcome over time. That's also where most people struggle, not because they lack information, but because they lack clarity. And that's exactly what SetWiser focuses on. Not just telling you what's happening, but helping you understand how to think through it.